Good morning. Welcome to the XM.com weekly market update, and we're joined once again by Peter McGuire, the CEO of XM. Pete, welcome back.
Good morning, Andrew.
Well, it's our last wrap for the year.
Yeah.
We'd like to cover off big year 2022.
Oh, it's been a monster.
It certainly has. So we'll start domestically again. We've had unemployment data out last week again.
Yes.
Still, we can see it seems to be the labour market is probably the strongest part of the market at 100%. The moment, considering what else is happening.
Oh yeah, all the moving parts. But as you said, it keeps on going down, and I think that's a good sign. So that's where you want to be.
It might be the last pillar to fall when we look at all the other data at the moment is clearly...
Housing starts and manufacturing and, of course, building and, yeah.
Everything is down in a lot of the other sectors. Then, and this plays into the next slide as well. This is the Westpac Consumer Confidence Index. And you look at that, now that goes back over a long period of time, but you look where it is now, and that if that's the consumer sentiment in the market, it's not a great looking chart.
No, it's certainly not. And there's the story, and what we've seen in that tail off over the last year has been just one-way traffic. And how low does it go? And do we break that, 06 or 07 or probably 08 sort of handle where we were in the GFC? So I tell you what, 23 is going to be one fantastic year.
And you were looking back, the GFC was clearly a lot worse than where we are now.
Yes. Absolutely, it stayed there for a lot longer and then it bounced. So we're going to see what they're going to do as far as rates, and we've got a different set of, I suppose, economic conditions. You've got high inflation now, where we didn't necessarily have high inflation at that time.
Yeah, I know. Interesting times. Now Japan.
Yeah,
plenty of activity. I know.
What a week. I mean, the rhetoric's out. Everyone knows the storyline. The movement was just incredible. 131. From 135 that year, and it's strengthened dramatically, and it's just they've bought the whole storyline.
Well, it's interesting considering the interest rates have been pretty much plateauing for a long time.
A long time.
So for that to come out, sort of out of the blue as well.
Yeah, very much so. It hit the traders out of the blue.
It did certainly move the market.
Oh.
But we look here as well, so obviously the CPI is going up a little bit in Japan, which is nowhere near what we're seeing in the other advanced economies. No. But you look at sort of the real cash earnings there as well, and those figures aren't great either.
No, well, your CPI is running at around about 3.2% at the moment. It'll edge up higher naturally over this the winter period. And what happens as far as yen, what happens as far as there you are, your monthly cash earnings. It's going to be a fascinating year for Japan. And how aggressive is that yen going to be? From 130 to 150, it's been just boom. Yeah, great time to be a currency trader for Mrs. Watanabe.
Yeah, well, I think it's the currency traders always have a pretty good run, don't they? There's always plenty of volatility.
Oof.
UK CPI, it did come off a bit, thankfully, but still 10.7 is a big number.
It certainly is, and you've got the Christmas time now, and where are we? Energy prices are up. We were talking before we started the show, up 10% since the 10th of December.
Yeah.
So it's running at 1% up a day. Crude's been bid well up, and we're nearly back through 80 for WTI. We're at $83 for Brent, and you know as well as I do the impact it has to the consumer over there and to inflation out of the UK.
Yeah, and they've just raised interest rates as well. But in the UK as well, consumer confidence. We saw the Aussie numbers. These numbers aren't great as well. No. This only goes back over a 12-month period, but they're big negative numbers, and which plays into the most likely a recession in the UK sometime in the new year.
Yes, definitely. And that's not looking good. I mean, where we were in September, so we're back still around, are we going to breach that 50? 23 is going to be 1 year to remember, I'll tell you.
Yeah, so now the US, plenty of activity last week with a lot of data coming out.
Yes.
We look at the US 10s, they have crept back up a little bit this week. The S&P, they liked the CPI numbers last week for a day, and then Jerome Powell spoke, and then the equity markets got hammered for a few days.
Exactly.
It recovered a little bit overnight last night.
Yeah, it was a nice move to the upside.
But they certainly didn't like the commentary coming from the Fed.
No way. No, and that worries all traders moving forward again into 23. We've said it once, we've said it 1,000 times. You thought 22 was volatile, wait till you see 23.
I guess the only positive is that central bankers don't have a good track record of their predictions.
No, they don't.
So if he's sort of saying that it's going to be at 5%, who knows where it'll be in 12 months' time. So, which is 5% is not that much higher than where it is anyway. It's only around 75 basis points. So
if you can contain inflation,
true,
that's going to be the number.
Yeah, but a lot of those the data out of the US, a lot of those numbers are coming down. So you would sort of think that'll feed into those inflation numbers in the coming months.
Absolutely.
Just a quick snapshot over the last 12 months. The green there is the Aussie market, which in all respects has performed pretty well. It's down about 6.5% for the year.
Yep.
The S&P is around about that 19%, but it's the NASDAQ that's been hurt the most.
Rated.
A bit over 30% down year to date.
Yeah. So how that's going to look again next year and moving forward with PEs and so on.
Yeah. Or is it a good buying opportunity? That's where the optimist would come in, Pete.
Oh, we're optimists, Andrew. It just depends on how long you need to be an optimist for.
That's right. Now, talking about PEs, we look at the various markets here, and those UK markets there, you would probably say are fairly valued at the moment. Obviously, the NASDAQ there sitting around 23, S&P around 17, you would sort of say are still nowhere near as expensive as what they were.
No.
But are they still a little bit over the top?
Well, when you go to the NASDAQ, and that's 12-month forward, and it's the green at the top there down to 23.8. Imagine if you had that NASDAQ that hadn't wiped out 31% of its stock price. I'd hate to think what those earnings would have represented. They're probably closer to that, 35 to 1.
Yeah.
So there's the first part of it. But as you've said, if you're looking at the UK, the FTSE 100 and the gold there, 10.1, it's not too bad forward earnings, is it?
Yeah. So there's a lot of commentary around these PEs at the moment saying that the US probably has a bit to come off before you can sort of say, can we dip our toe back into the water? So
sure.
Yeah, time will tell. The last two slides here, we'll take the pessimist outlook first of all. So this gives a chart of since 1928-29.
I remember those years well, Andrew. You were ahead of me at school.
The S&P has been two consecutive years or more has been down on 4 occasions.
Yep.
Okay, but the key statistic here is the second year has always been worse
than the first
year. So that's not to say next year will be a down year, but if it follows that trend, then we're down sort of anywhere between 20 or 30% on the US markets this year. If we have another down year next year, history would tell us
it's going to be more severe.
It would be worse.
Yep.
So once again, history doesn't always repeat, but it's interesting stats, but it's only happened on 4 occasions in that 95-year period where it's been down 2 or more years.
Sure.
So that's a negative look. A positive look, this is the return on the S&P over that 95-year period. So there's 26 down years and 69 up years.
Yeah.
And you look at some of those up years, some of those returns are
extraordinary. 2013, 32% up. 1989, after the crash, 31.5% up. So they're, you still look at 87 there, and it's up 5.81%, yet, it was absolutely cratered with the crash. 95, what a year, 37%. The other thing is, it's all compounded earnings. So in other words, it's what you earned last year. This is what you earned on that. So it's dramatic moves. As everyone says, if you want to make $1, long-term holding, have a look at 33, up just under 50% up in that boom. So they come back and
a few of those years, like you got 4 years in a row from 1929 and 3 years in a row from 1939. So it's a long, long time ago. And the markets wouldn't have been overly sophisticated back then.
No, they wouldn't have been.
But even even look at the last, not this year. Obviously, this year's down around 14%, but the last 3 years up 31, 18, and 28. That's just those numbers just aren't sustainable year after year after year
at minimal interest rate.
Yeah.
Well, and inflation.
Well, there was plenty of free money floating around the last few years. So. But that's an interesting chart. So I thought we could look at the pessimistic side and the optimistic side.
Yes.
So, who knows what next year holds? Obviously, still going to be plenty of volatility.
Yeah.
Like we spoke about earlier, it's probably the most telegraphed recession anyone's ever talked about, if it eventuates.
Well, we're going to throw a coin up because we're going to be this time next year. Hopefully, we're both in good health and we're both here doing this. I'm going to say it's going to be worse, and I think that the inflation story hasn't been put to bed yet, and I feel as though that the Fed will continue to have to aggressively raise rates. But I'm just putting that out there, and that's certainly not advice, but that's just a feeling I have of looking and studying markets, and I'm just going to say at the end of the year, I think it'll be lower than what we are, and I think it'll be a greater loss than that 13.8 for next year. That's my view. Right. We'll have volatility over the year, but at the end story, that's where I'm looking.
Right, I'll take note of that, Pete, and we'll see.
You're not prepared to have a go.
Well, I reckon we'll be positive.
Do you?
I'll take the counter argument. Well,
okay.
I reckon the first 6 months of next year will be very volatile and could be in the red. But I reckon after that, if inflation has got, it won't be at 2 to 3% at all. I think it'll be probably close to around that 4 or 5%. And I suspect interest rates will be coming down by this time next year, saying that they need to get to 5%, which is not that far off anyway.
Yep.
But if there's plenty of pain in that first 6 months of the year, which I suspect there will be, I think the central banks will probably have to change their tune into the back end of next year. But
sure.
There we go. Opposing views.
Yeah, it's always good to have opposing views.
We'll see where we sit in 9 to 12 months' time.
Throw the coin.
Excellent. All right, Pete. Well, once again, it's been great talking to you throughout the year.
Thank you, Andrew.
All the best for Christmas and the New Year.
Yeah, Merry Christmas to you and to everyone at your wonderful studios in Sydney.
Yeah, that's all right. And we'll catch up in 2023.
God bless you.
Excellent. And that's the XM.com weekly market update.